So, guys, it is our third session with Rajeev Agrawal, sir. He's a CFA and managing partner and fund manager at Doordarshi India Fund. So, basically, a India fund based out in the US. And sir has been investing in the US and Indian equities for over 15 to 16 years. And he firmly believes in the principles of value investing, and last two sessions were great. We had discussed about his framework and the present situation at that point in time. So if you guys are yet to have yet to go through those sessions, surely you can check out over my YouTube channel, or I'll share the link afterwards. And today, since we are in a time wherein everybody is of the opinion that the valuations are not, nobody wants to miss out the rally. So I thought it is the opportune time to ask Rajiv sir for his time to discuss the market risk and opportunities, if any, available in current point in time. So a very warm welcome once again, Rajiv sir. So in the opening note, I would request you, like, you talk about the current market out, positioning yourself.
Sure. Prince, thanks a lot for that introduction. It's great to be back with this community. So once first, Prince, I should congratulate you because I think last time when we talked, your following was much smaller, and I think it has grown by leaps and bounds. And so I think it just shows the type of content you are putting out and the guests you are bringing, and the benefit all the listeners are getting from that. So congratulations to you for a wonderful, wonderful job. Um,
Thank you so much.
in Sure. Now, in terms of the markets, clearly the markets have run up quite a bit. And I think really how to think about markets is, I believe Howard Marks said it best. And he said that while we cannot make decisions based on what markets are doing, we should definitely be aware of how the markets are. And I would say that the markets definitely look to be on the ebullient side. Clearly, there's a lot of excitement. A lot of money is coming into mid cap and small cap space. And that has driven the valuations of many of these stocks to unprecedented heights. I think another reflection of why the markets look a little bit on the higher side is the fact that IPOs are coming and they're getting subscribed at a very, very high multiples, very difficult to get allocation. And that is another sign that there is too much money chasing too few stocks. And for many of the participants, if they were around in the 2017 to 19 period, the current period looks similar to 2018, late 2017, early 2018, when a lot of money was chasing a few opportunities in the market. Now, having said that the market looks a little bit on the higher side, that doesn't mean that there are no opportunities. I think in any markets, when you are looking at 5,000 stocks that are listed, and as a portfolio, you just need to have only a few stocks in your portfolio. So I think there are opportunities and there will always be opportunities. The important thing is to realize that those opportunities are things that you find based on your own analysis and your understanding, and not because of what others are recommending. And what does happen in markets like this is that everybody becomes an expert. The portfolio has done well, and those are the times when we lose our discipline and start following what others are saying, what others are doing, and start chasing the next multi-bagger that somebody else has achieved. In fact, there is a famous saying by Benjamin Graham, the father of value investing, or the father of investing, and he said the biggest risk is not out there, but the biggest risk is in our own self. And I think that is the best way to think about the markets and the best way to think about the risk. And that is that if you can manage your own discipline, manage why you are buying things because you understand them, and because you have a good sense of what it will do. then I think it's a good opportunity to take advantage of. And I was thinking about the risk and opportunities. And one of the ways of thinking about risk and opportunities is that if you think of a stock and you say that even in the best case, I don't make a lot of money, that's a very risky thing, right? And on the other hand, if you think about a stock and even in the worst case, you don't lose money, that's a wonderful opportunity. So risk is and opportunities are two sides of investing, obviously, but we need to always keep in mind that as long as we don't lose money when we are investing, I think that is the best way in terms of investing, and that is where people should focus on, and that will depend on each person's expertise and their knowledge. So that's how I will sort of describe the current situation, Prince. Happy to go anywhere from there.
Great, sir. So, Rajiv, sir, we had, I mean, the current market situation appears to be on the sense like even the RMs in the banks are saying that people are more inclined towards equities, and the money which was going into the debt instrument or the simple saving, that is moving to the equity, and that is causing the banks, I mean, basically the cost of I mean, the money is raw material for the banks, and if its cost increases, then definitely the spread decreases. So, how you see this current scenario building up and going forward? What could be the possible repercussions of this?
So that's a very, very important point, which is that earlier equities was seen as a very risky asset class. And I think what you are saying is that more and more people are realizing that equities is becoming a lot more mainstream in the Indian investors, asset allocation. Now, I was recently looking at the household savings and how Indians invest their household savings, and less than 10%. So I think it was 5% is equities, some portion is through the PPF as well as insurance, but most of it is in fixed income. And so, as people allocate more and more to equities, clearly there will be a bigger flow into equities. And that is the point you are making. And I think that's a very fair point because, in general, Indian investors have been under allocated to equities and over allocated to fixed income instruments, including fixed deposits and gold and real estate. Compare that to, let's say, 10% in Indian investors. I think typically folks in the US markets would be 40 to 50% allocated to equity. So clearly, there is a big, long runway for Indian investors to catch up to equities if they want to continue to increase. And so, given that allocation, why shouldn't the markets continue to go up? And I think that is absolutely possible that the markets continue to go up. I think the important thing to realize is that just because the markets go up doesn't mean your stocks will go up. And so the important distinction to be made there is that I think we all have a good tailwind. We all have this good opportunity where more and more money is getting allocated to equities, and we should all take advantage of that. But just because more money will come in doesn't mean that the stock which does not have, or the stock which has gone up a lot and does not have a very strong business model, will also go up. And I think the important point is to look at businesses, and that is really where one differentiates oneself from the rest of the crowd, is to understand a business and then buy it at a reasonable valuation where you can make good money going forward. As long as you can do that, and as long as you can find those opportunities, I think the market still is providing opportunities like how I was talking about. And actually, what has been very interesting in the last few years has been the significant flow that comes from systematic investment plans, as you were saying, into Indian equities. And I think that will continue because Indian investors have woken up to the fact that equities will give good returns. But we need to be cognizant of where we are investing and why we are investing, and why is as important. If you're investing because the business will do well and therefore the stock will follow, I think that's one thing. But if one is investing because the stocks have gone up and you don't even understand the business, then that is where it's highly risky and it can lead to big problems when and if those stocks were to come down. Because the problem in those situations is you don't know what to do. And that is why, while many people will suggest different stocks, one has to do your own work and then decide what stocks one should buy.
100%, sir. I agree on all the point you just mentioned. So, Rajiv, sir, like if we talk about the US and the Europe, so how's the global situation and demand supply going on? And moreover, like, what's your take on Indian domestic demand?
Yeah, so I think that's great question because the macro at the broader level is equally relevant. I think what is surprising to many people, including myself, is that everybody expected 2023, when the federal fund rate went very high, that will curtail the demand in the US economy. But the US economy grew quite strongly in 2023. Similarly, people were expecting that high energy prices will impact Europe, and China has been in doldrums. So, if you look at the broader world economy, the expectation was that 2023 would be a challenging year. And it is actually quite surprising, especially for US, that even with the high interest rates, the demand for housing continued to hold up quite well. And the economy actually did quite well as well. Now, that is obviously the past, and past is good. But what does that mean for the future? My view is that in US, even though the interest rates are high and even though the people have much higher debt, the bigger debt is more at the government level rather than at the corporate level or at the personal level. And so that is one thing which is actually not hurting as much. The second thing that is actually helping the US economy do well is the fact that the US employment or unemployment rate is at a very low level. And that means that pretty much most people have money coming in through their employment on a regular basis. And that allows them to continue to spend on things that they need. And therefore, the demand in US economy seems to be quite strong. We are seeing Japan come back, which is very interesting. And Japan is coming back quite strongly, both in terms of economy and also in terms of the stock market, at the cost of, let's say, China, where the economy is not doing as well and the stock market is definitely not doing well. And then Europe, which has been sort of in a mediocre range, let's call it. And compare all that to India, where I think the demand is very strong. And if anything, the demand is so strong that RBI and the central bank continues to push for reducing the credit demand through one form or another. And that is indicative of the fact that the Indian government non or counter cyclical measures in terms of the capex that they have done, in terms of how they have been able to bring confidence in the Indian economy and get the either the PLI working or FDI coming in, FPI coming in. I think all of those things have created a lot of momentum in India. And I believe that that momentum should continue, not just because of what Indian government has done, but also because of how geopolitics is playing out, where India clearly is seen as a China plus one option, increasingly more so. And I think as you build momentum, as you start having a few companies come in, who in turn gives confidence to the next set of companies that they can come in, and that is coming in a very strong manner on the manufacturing side. On the services side, then, I think India has always been a very strong economy where we keep seeing good demand and more companies allocating resources into India, given the inherent advantages of India. So I think both on the services side, which has always been a traditional sweet spot for India, but increasingly more so on the manufacturing side. And then lastly, on the infrastructure side, I think the demand in India seems very strong, and it is likely to be one of the key drivers, I feel, of the growth for not only India, but even over time, it will start helping the world growth as well.
So, Rajiv, lovely to be here with you. So, on that note, when you talk about the China plus, there's a lot of a lot of work being done and research coming out that there is completely a kind of a focus going back to India, Is that really real or is just a talk? That's one question. The second question was going back to what Prince asked really about there are a lot of people speculating, saying that there's a market correction coming in. And, we went through this in 2023. What is your take on that? Because we're looking at both the markets, India and US, have a crazy political market, political system coming up with the elections in India in May and then November in USA. What do you think will happen? Will you see any kind of a market correction this year, or is just talk or speculation?
Sure. No, again, wonderful questions. Thank you. So, in terms of the China plus one and where India is placed, I think clearly China is by far way ahead of where India is in terms of the manufacturing prowess. And the scale is very different right now. But what we are seeing, and as I talk to people around, clearly there is a growing trust deficit with China and the West. And given that, I think Apple is a great example of how a Western company, which was so reliant on China, can quickly pivot, right? And obviously, when I say quickly, it still means at least a few years. So it's not that quick. But still, in the grand scheme of things and how much of manufacturing can move from one country to another, I think it is clearly happening. And when you see one of the very big companies able to achieve the type of revenues or sales that is coming from India, I think it is giving a lot more confidence to the next set of companies of taking advantage of India. I think this journey is actually not a 1 or 2 year. I think it is a 10 year, 20-year type of a journey in which India can truly become sort of a China plus one. But the fact that it is happening and we are seeing some tangible examples of it gives a lot of confidence that this will only actually, in my mind, speed up. And when I talk to people, it is interesting. I would like to contrast now versus, let's call it 2017, 18. When I would go to various conferences, and at that point, pretty much you bring up India, and nobody wants to talk about India, right? Nobody. Everybody would be interested in talking about China and how big China is and what are the growth opportunities and what the economy is doing and all that. And I think the narrative, I would say, has only started changing after the whole 2020 debacle, right? And since then, obviously, two things have happened. One, the markets have done well in India versus China. And second is the rhetoric has only increased. And so I think both of those are increasing the move towards India, but also the interest in India. And I think as interest comes and as people figure out what's happening, that is also improving the desire to come into India. So I think it. To answer your question, I think the first question, I would say that the interest is real, and we are seeing very tangible examples of it. And if you ask me, my thinking is that it will only speed up from here, given the interest, but also the welcoming policies that the Indian government has adopted. To your second question about the market correction, given the political changes that are coming up, both in India and in the US, I think I would say the Indian market has pretty much, from a political angle, pretty much made its decisions or made the expectations quite clear. The good news is at least there was an election in India, which gave a lot of people a lot of comfort. Um, and any surprises there, of course, will be a big shock to the system. So if the expectations and the reality are very different, then clearly that's a huge risk. I was talking to somebody else, and one of the big risk from an Indian perspective is the person specific, the key man risk that we have. Clearly, that key man risk is huge. Everybody is bullish because the policies of the government and our current prime minister has worked out very well. And of course, the risk is if something happens to him. And that is something that nobody can rule out. But I'm sure just knowing how important that is, people are taking care of it. In terms of the US election, the US election is a much trickier sort of subject. Clearly, I think the division between Democrats and Republicans just continue to grow. And what we are seeing is that there's almost very little point of overlap in how the two groups think. And I think what is what is surprising to me is that the same fact can be taken by two different political supporters in two very different ways. Now, the good news is that the government has obviously an influence everywhere, but in the US system, the government influence is limited in terms of how much they can influence the corporate world, other than taxation policies and things like that. Um, on top of that, the markets in US have done very well. And if you look at market cap to GDP and so on, clearly it is looking at a very high level. So the risk exists in the US market. And I would say, given that the markets have been driven by the Magnificent Seven and so on, I think the risk is that if something weird happens. And I would say the risk is not necessarily from a US system as much as from an outside system, like let's say some geopolitical conflict somewhere else that could, or a very big economy suffering a big downturn, which could have a cascading impact everywhere. I think those are the bigger risks in my mind than possibly or something, a big company suddenly found making egregious cooking up books and stuff like that. Those are the type of risks I would think. Political risk, while being there, is well understood by the market, because what I'm saying about the political system in the US is no secret. And so I think if something is not a secret, obviously everybody has accounted for it. So I think that is less of a risk in my mind.
Thank you, Rajiv ji. Very, very useful. Just a basic operational announcement, everybody. Can you please retweet the tweet that Prince has put out, and also DM folks who want to join and benefit from such an important speaker today? And also, I really encourage everybody to go to Rajiv ji's timeline and retweet some amazing tweets and information there. Do follow our lead speaker today and the host, Prince, because the amazing spaces coming through. Sorry, guys, I just had to make this general co-host announcement. Everybody, please retweet the space and share it with others to join in. Prince, to you.
Thanks. Before coming to Sam and Vineet, one quick question, Rajiv ji. So basically, the Red Sea issue is causing trouble. So short term and quite mid to long term consequences you see in line with this ongoing issue.
Yeah, Prince, again, very interesting. So this whole Red Sea conflict, I actually was much more worried when the whole conflict started last year, because clearly that particular region has a lot of oil. Everybody needs oil for the energy needs. And it has been pretty interesting to me how the various governments have behaved to ensure that the conflict does not get escalated. It obviously has been going on, but the fact that the governments across the spectrum have tried to keep it low key tells me that everybody realizes that the risk of aggravating or making it bigger could have dire consequences, not just for other countries, but for themselves as well. And so I think it is their self interest which is ensuring that the conflict is well contained. Now, whenever there is a conflict, there's always a risk that there's some surprise and things completely get out of hand. And so that risk exists, and I don't think it goes away till the conflict gets resolved. But at least the actions by the various parties so far tells me that they want to ensure that things don't go completely out of hand. And that is quite helpful. Just because energy is such an important need, if that were to change, I think the whole spectrum of what inflation looks, what interest rates look, what prices look, and all that will come to completely change. And I think the markets can have again a very strong reaction to that.
Great, thanks. So Vineet, you can go first, and then Sam and Wall Street. Yeah, Vineet, over to you. Vineet, you are on mute. You there? Okay. Meanwhile, okay, yeah,
Can you hear me?
yes, we can.
Vineet, you'll have to come closer to the mic. We can't really hear.
Sorry, I have a bit of an audio problem. Is it better now?
Yes.
Great. Rajiv ji, thanks so much for taking the time. So my question, you spoke some time back about the state of the US economy and how things could be going forward. I wanted to just check with you on your thoughts on the fiscal deficit situation in the US and the fact that it's close to $2 trillion and this being an election year. Do you think that kind of a deficit can sustain or maybe even grow and fuel growth in the US this year, or do you think that there's a chance that they might want to pull back on it and bring it down to more historical levels, and could that then put a downward pressure on growth while interest rates still stay high? Is that a risk, a tail risk that we need to factor in?
Yeah, Vinny, thanks a lot. It was great meeting you as well recently. So I think my sense is that fiscal deficit is clearly out of control in the US. The US is spending a lot more than, in terms of percentage, than what it is bringing in, and I think that fiscal deficit situation is just getting worse. But also, there is no party, either Democrats or Republicans, who are interested in curtailing that fiscal deficit. And so I don't see, at least in the short term, any drive by any of these prominent parties to curtail the fiscal deficit and therefore curtail the spending. And one of the reasons I feel, and again, it is interesting, but one of the reasons I feel that the US economy has been as strong as it has been is because there's so much of spending happening. And because there's so much of spending happening, there are a lot of jobs. So we have a low unemployment rate and high growth rate. The problem, obviously, with high fiscal deficit and high spending is high inflation. And so I think one interesting area where I disagree with a lot of the consensus is this expectation that inflation will now be tamed and gradually the interest rates will come down to a 2% level over the next year or so, or maybe 2 years. I feel that, and again, I don't have a lot of strong basis, but this is my hunch. Given the huge fiscal deficit and there is no immediate desire by any of the parties to curtail the fiscal deficit, I think the spending will continue. And therefore, the tendency for inflation to be on the higher side is likely to be there. And therefore, the interest rates may not come down as much as all the prominent Wall Street firms think it will. And to that extent, I would assume that the growth will continue, but so will the higher interest rate. And given the situation where the unemployment situation is quite strong, it will not necessarily curtail the growth rate in the US economy.
Right. So next speaker in line is Sam. You can unmute and ask your question.
Oh, yes. Thank you, Prince, for making this first. And thank you, Rajesh, sir, for accepting
Sam, you are breaking.
regarding the very audible.
Sam, your voice is rubber banding. Can you try
Oh,
again?
still my voice is not clear.
It's fine now. Yes.
So my question is regarding Rajesh sir has a well understanding about the BFSI space. So can you please give a quick overview about the wholesale, retail, and microfinance lending is happening and valuation about private sector bank and public sector bank? A quick overview regarding the sector because you have a very good, pretty good understanding of this sector. And second question is regarding we are kind of a new investor. Lots of investors started their investing journey after 2018, 2020. So we haven't seen that phase in last 3 to 4 years where market consolidated for years and market goes down, investor don't able to make money for 3 to 4 years. So you have a decent amount of experience you can get that person.
Sorry, Sam, I understood the first question, but I could not quite understand the second question. Are you saying how to be able to address the drawdowns? Was that your question on the second question?
Oh yes, that was the question. Second question: how we can able to take the drawdown and how we can basically bear the consolidation phase of the market.
Sure. Okay, great. All right, thanks. So, Sam, again, good to see you and good to hear your voice. So, on the BFSI, I think it is very interesting to me about the whole BFSI segment in India, and I would say more on the lending side. I don't really focus as much on insurance, but always something that I'm happy to learn about. And so, if there are anybody on the insurance side that can help me understand that sector, would be very thankful to them. So, if you feel you have a good understanding or you have some reports or something that you feel is a good way to understand insurance, please do forward, because I think that's an area I would want to keep learning on, even as it is with lending. But on the lending side, I will say that I have always felt, and this has been a feeling for a long time, and I still feel so, that Indian economy has under penetration of credit, right? And because we have under penetration of credit, the credit growth that we have had in the economy, while fantastic, I think is going to continue for a very long time, because traditionally Indians were not borrowing. And because Indians were not borrowing, there was not as much need for credit. And it was very hard to find credit. I think that's the most difficult part. And I have, having lived in India, having seen the lowest strata, and let's start with the lowest strata, and let's start with MFI. I would say the lowest strata of the society, if you give them a little bit of credit, little bit of money to start the businesses, the incomes can grow many times. This is because all they need is a small amount of property. It could be a small shop. Uh, it could be dairy. It could be growing vegetables, whatever it is. But just if you give them a small amount of money, they can start the business. They can start supporting themselves. They become entrepreneurs. And I think India needs more entrepreneurs, needs more people who are excited about the work they are doing. And so I think in the MFI space, and we have had a lot of MFIs come out with results in Q3. I feel that MFI has been always a challenge, or the lowest strata of the segment getting credit has always been a challenge. And MFIs are filling that role. And I believe that that will continue. Again, this is a long term trend. When you look at how many what population percentage can benefit from this particular industry, I think that is huge. And clearly, as the segment has tasted that being an entrepreneur running their own show, they can make good money. Now they are graduating and actually increasing their credit need and doing something bigger than what they have done. So I think at the lowest strata, be it MFI or MSME segment, I think that particular segment has grown very well, as many of you would have noticed in the recent results, but over the last few years. And I think that will continue. Now, if we then come to the personal loan segment, and this is where RBI has recently tightened the norms. Clearly, RBI feels that there is a um, lot of lending that is happening, which is either not well, not having enough transparency in terms of the borrowers, or where the rates are too high, or just seeing too many different lenders pursuing the same customers. I think it is great to have some sort of checks and balances along the way. We don't want to have runaway situations where if you suddenly just lend because there is a demand, and then we have the other problem where effectively people are not able to repay. So, to my mind, having those checks that RBI is imposing will keep the discipline in the lending sector. And frankly, many people think of it as a negative. I think of it as a positive, because unless you have checks, things can get out of hand. And so, be it personal lending, I think all of that in my mind looks good. If I then go to between the public sector and the private sector, banking, which you were talking about, in my mind, the public sector has been on a fantastic run the last year and a half, or maybe 2 years. And one of the reasons why they have been on such fantastic run has been the depressed valuations that were existing in the public sector banks. Even today, if you look at it in terms of how these banks are performing and how the valuations are, they don't look expensive in a market which looks pretty ebullient, right? And so, while the private sector banks have not done much in the last let's say, few years. Maybe some banks have, but not others. And so the private sector banks have not done as well, let's call it, as public sector banks. And that is again because earlier the private sector banks were taking a lot of market share from the public sector banks, and public sector banks were having the issues of high stressed assets and not enough capital. Now the stress has been resolved to a large extent, and actually stressed assets is falling, and that is giving the public sector banks leeway to start lending, and therefore there is more competition that is now in the system, which is preventing the private sector banks from growing as fast as they might have otherwise. So I personally continue to believe that the lending space is one of the more interesting space out there for people to look at. It is obviously a much more, it is a leveraged segment. And so one has to be careful that you understand this segment well, because if you don't, while the returns can be good, so can be the risks. And so understanding why you are investing in a particular company, how does that particular company or bank compare to something else is important. But in my mind, I think this sector still has a very long runway, and many of the companies out here are not necessarily expensive given the prospects. And so I continue to like this segment. Now, in terms of the second question, for new investors, if the markets are consolidating or if there's a drawdown, how one should handle that. My view is that there's nothing like real life experience. So you can read all about how to handle drawdowns, but you only know yourself when you go through a ringer, right? Now, but a few things that I would suggest that any new investor should do. One, always keep enough buying power, right? So you should never be so fully deployed that if there's an opportunity, you have nothing that you can do. You should ideally have firepower to be able to take advantage of the drawdown. So in my personal portfolio in the past, I would always keep a certain amount of cash, and that cash will depend on the opportunities. But I would encourage people to have some amount of cash so that you can. And you should also be thinking about, if I need to raise cash, where I will be raising cash from, as in what will I sell to buy whatever that I want to. What will I sell so that I can buy whatever I want to, right? So you should have that ready list of selling, buying, and of course that will change, let's say on a weekly, monthly basis, depending on how the prices move. So I would say that. I would also say that there is a tendency that all of us have of trying to make the most money in the shortest period of time. And what we forget is that we have a long life and a long investment journey ahead of us. And so having a long term view makes it a lot easier to not worry about the short term drawdowns or the consolidation that may happen. Because if you can think long term, then the volatility, which many people think of as risk, actually becomes your friend. And by taking advantage of when everybody is becoming negative and you have the firepower to take advantage of, you actually can take advantage of those opportunities rather than suffer from it. And for that, you really need to have a long-term mindset where you should be thinking in 5 years, 10 years horizon, especially in your personal portfolio, rather than a 1 year, 2 year horizon, or maybe quarterly that some firms may have, right? And that actually is a huge advantage that individual investors have, which I think many people don't realize, that given your own investment journey and the fact that many of us here have still many decades in front of us, I would say there is no reason to be in too much of a rush to make all the money in the shortest period of time. We also should only be investing in firms that we understand, because many times people will ask me, listen, what is a good stock? And I will say, I will tell you that, but what will you do with it? Because you don't know why you are investing in it. And suppose the stock goes up 20%, what will you do? Will you buy more or will you sell? And similarly, if the stock goes down 20%, what will you do? So the biggest risk I think an investor can have is to take tips from other people rather than trying to understand the business and understand why they are buying it and understand what they expect from that buying. Because once you do that, you then will have the ability to actually take advantage of these opportunities that the markets will throw at you from time to time. And if there's one lesson, I will say, don't be in too much of a rush to make money, but be in a rush to understand the businesses and see and why they do well. And then over time, build expertise in areas that you feel you have natural interest or talent in, and then double down on those areas.
Thanks, Sam. Uh, Anything more on your end, Sam?
Thank, thank, thank you, sir. I would like to ask one more question, if you allow me, Prince. Then
Uh,
should I ask?
Quickly go ahead, please.
Yes, yes. So this question is regarding artificial intelligence. So due to AI, information and analysis is no longer going to be our edge. Because of that, our mind is bound to take more and more decisions. The more decisions we take equals to higher will be the error rate. So how can we enhance our behavioral edge and be patient while learning AI in finance to improve our analytical and information edge?
So actually, again, this is one area where I have a slightly different view than the prevailing view. And my view is that artificial intelligence is all the rage today. But frankly, some form of artificial intelligence has existed for a long enough time, right? People have been doing data analytics, people have been doing hedge fund trading or high frequency trading for a long period of time. And so we can call it artificial intelligence today, but this form of intelligence where you look at data, try to make sense of the data, find patterns in the data, has been existing for a long time. Clearly, what is accelerating the trend is the more powerful computers, the more powerful chips, and if anything, this will continue to your point. But what I also feel is that a lot of these tools will be very helpful in finding patterns in the short term, right? If you think about it, okay, what will happen? Where are the inefficiencies? Where are the arbitrage that exist between two different stock markets right now, right? And can I take advantage? Now, that has been existing for a long time. Now, can it possibly help you extend from a minute to minute to maybe a day to day? Possibly, yeah, that can happen. But will it then be able to tell you what happens 2 years out? Because artificial intelligence is so much powerful that do we think that it can start predicting what the business will do 2 years out? I don't think so. I think the day that happens, pretty much we can assume that the humans don't need to run companies. We can have the artificial intelligence run companies. So my view is that artificial intelligence, while it will have advantage in the short term and actually will reduce humans' advantage in the short term analysis, I think for the long term analysis, that advantage will continue. If anything, I think it may even become more powerful for us because uh, everybody will focus on the short term too much, and that may create more volatility and therefore more opportunity. So that's one thing that I feel artificial intelligence for long term investing is not necessarily a threat. But what I think we have to do is because we will assume that the information and what the markets are responding is effectively correct. It is possible that we will also be swayed by it. And this is where the second aspect of your question, which is behavioral advantage, will become much more important. And therefore, our ability to assess a business and have our own views on that will become even more important. And then not only do you have to have your own views, you need to be then willing to hold on to those views and not be swayed by the markets. In fact, let me also just contradict myself, what I just said, because while I am saying that you need to have a strong conviction about your own ideas, I think it is equally important to be willing to change your mind when the facts change. And I'll just give you one example. I own a stock. I'm not giving a specific name on that. And as I was looking at the recent results, I felt like my initial thesis on that is no more as much valid now, given the new numbers. right? And so I feel that in investing, not only should we need to have our own conviction, but we should also be willing to change our conviction if the facts change, as is the famous saying, right? That John Maynard Keynes, what do you do when the facts change, right? Many people will keep on to their views. And so our willingness to change and when the facts change is as important. And I believe those behavioral aspects of keeping or holding on to your conviction and then willing to change it when the facts change will be required. It has been required. I think Buffett had talked about temperament being very critical, let's call it 20 years back, right? And I think, if anything, those aspects become even more important. So I absolutely agree that our behavioral advantage has to be continued to be honed, and that can only be done if we understand our business as well.
Thanks, Sam, for your question. So next in line is Amit, if I remember the name correctly, Wall Street. You can
Yes,
unmute
correct,
the mic.
Prince. Thank you, Prince. Hi, Rajiv. Good evening, and if you're in US, good morning. And so my question is, Rajiv, you have seen recently Tucker had an interview with Putin. What is your thought process on that, and what Putin gave inputs to the Tucker, and those are crucial for the upcoming future market and looking at where we are moving, and from the geopolitics as well, and it has an impact on the market as well, clearly. And second question, what I have is, I know there's a fintech going on in 2024, and a lot of people are being invited in that. Some of the topics, as per top of my head, what I understand, discussion topics they have is open banking, API integration, SME banking, and embedded finance, blockchain impact on finance tech, AI, BaaS, that's a banking as a service, lending tech innovation, digital public infrastructure. So, what do you think about what is the key? What do you see from that? Fintech will come up from Indian perspective and for the Indian audience, and from the US perspective as well. Thank you.
Sure. Thanks a lot. On your first question, my answer is very easy. I do know that Tucker did an interview with Putin. Actually, I did not read it or did not watch it, so I don't have a view. I will actually go and take a look at it because I don't know. I do know that he asked for release of Wall Street Journalist, but I don't know what were the other substantive conversations or inputs by Putin on that. So I would not be able to answer that first question because I don't know. On the fintech aspect, I think clearly technology is dominating what is happening in the whole finance space. And I think that is what makes it so interesting. I think in many, many aspects, the fintech or the technology aspects in India in the finance is so much better than in US. As an example, I was talking to somebody and he says, listen, in India, I transfer money and I get it in my account within a few minutes. While in US, typically if you're doing ACH, it takes a day or two for the money to show up. So I think on the technology side, I would say Indian ecosystem is far ahead. Even US did a recent change where you can actually start using FedWire to transfer money, but it has not really taken on as much as one would have expected. So I think technology and finance work very well because finance is pretty much bits and bytes, and technology enables that. And so I personally think that be it the aggregation platform that we are having, the API platform that we are having, and all of these aspects that are coming in will only make the finance ecosystem stronger. It will allow credit to become available to all segments of the society, and people who have good credit will obviously benefit, and people who have bad credit will actually get penalized as they should. So I think finance is going to benefit immensely from technology and all the API banking to everything. I mean, how convenient it is for most of us to bank and so get our needs serviced. I think today, when we have to take loans, there are like 5 lenders who want to give us loans, and that's perfect, right? Because we get good competition and we get good prices, and we want that. So I think finance and technology are pretty symbiotic, and I think that is happening everywhere. I just think that in the Indian ecosystem, there's a lot more innovation that is happening than what I see in the US ecosystem. And that is why I feel the Indian ecosystem, financial ecosystem, will continue to grow at a much faster pace, both because there is a deficit, but also because there's so much innovation that is happening as compared to the US financial ecosystem.
Thanks, Rajiv. So, Rajiv, before coming to data chart, so quick question on which sectors you think the valuation is not allowing you to hunt for opportunities, and which are the ignored sector wherein you are looking for opportunities. And again, if you club any view on the OMCs or the oil and gas companies, so that would be helpful for our audience.
Sure. I would rather than say what segment I'm avoiding, because by default, if I'm not looking at it, I'm avoiding, Prince. So I would say, the sectors which are still of somewhat interest. I mean, first, most companies in most sectors have gone up, right? But I think, as I was saying, to me, the lending space still looks interesting, given the opportunities that I see. Should also caveat that that has been a space that I have done traditionally well in. That is a space that I feel I have some understanding of, and so I'm clearly biased. Right. So I don't want people to take away that that is the best. It is just best based on what I understand. Right. And so I think lending in its various forms, and lending is a pretty broad segment. Right. So I think lending continues to be quite interesting to me because I feel there's a long runway. Still, the valuations don't seem as crazy given the prospects in my mind. And I feel to the previous question around fintech, I think more and more technology is getting embedded in these lending companies, which actually is making them much more efficient, which hopefully should bring the cost down and should then enable them to make better margins over time. Given all of that, of course, the competition is also significant, and I don't think the competition is going away. So the ability to understand that space and the players and what they do is important. The other segment that I would say, which is interesting, but I don't know if it is cheap anymore, is real estate. I mean, again, the problem with any segment that we talk about is if the what if the narrative is that no, this segment will do well, of course the valuations will go up. And I would say that in the real estate, after almost a decade of nothing happening from, let's say, 2012 to 2020, the last few years have been very good. And it feels to me that given the low inventory situation that we are seeing still, the increase in property prices over the last few years, and the number of players having come down, a lot of the unorganized players having fallen off. It seems to me that there still is a decent runway there. Now, given this expectation that there's a decent runway there, the prices have also run up a lot. In fact, 2023 real estate as a sector, from a pricing perspective, did the best. So the prices have risen a lot, but that is a segment which I feel can continue to do well. To your question on OMCs, the problem with OMCs, and this is a problem I don't feel I understand very well, but I will tell you my thoughts. And if our listeners have a counter viewpoint, I would appreciate if they can come back to me on that. But my view is that OMCs are obviously, oil marketing companies, obviously, are most of them are owned by the government. And they are then treated by the government to ensure that whatever the government wants is sort of reflected through them. As an example, there has been no change in the prices of petrol and diesel for a while, right? And now, if clearly at one point these OMCs were making losses because the prices were capped, and now they are possibly making good money. But if the oil were to rise, then they may again start making losses. So I think if you're buying OMC, one possibility is you are taking a view on the oil, and you can, and you buy through that. I just feel I don't have either good understanding or any advantage that I can make an informed decision around the OMCs. What are the segments? I mean, I think chemicals and agrochemicals is clearly something that has been beaten up It is a segment that I don't understand well. I have been at it for the last few years trying to understand it. I don't think I understand it well, but clearly going into areas which have been beaten up can create opportunities. For me, it is a work in progress. I don't think I understand it well enough to say, is there opportunity in that? But clearly, I am trying to understand and learn that and say, can I become more conversant and familiar with that segment?
Right, Rajiv. So, Rajiv, any view around the cyclicals, basically the sugar, cement, and the metals? Any opportunities you see, or you are keeping at a bay in respect of these sectors? How you are positioning?
Yeah, no, so again, that's a very interesting question because to me, and again, this is one example where I feel my viewpoints have changed, right? Earlier, I would say, no, cyclicals, I don't want to even look at it. Now, my viewpoint is, no, I will look at it and I will participate in it when I feel there is good opportunities in any of these segments. Now, actually, let's take each one of them. Sugar. I think sugar clearly with the recent government notification that you cannot use sugar syrup and molasses for making ethanol, which was a big story. Some of these sugar stocks have come down. I do think that the long term for the long term strength of that particular sector, ethanol will continue to be a good policy, and frankly that makes the whole segment quite strong in terms of self sustenance, because earlier you used to have a lot more cyclicality. And maybe because ethanol has become an important segment or important product from that particular segment, that cyclicality may come down to some extent. It remains to be seen because to some extent the cyclicality will also depend on what are the government policies around it. So I think that is sugar. Building materials is very interesting in my mind because clearly India is doing a lot of capital spending. And so you look at building materials, you look at metals, you look at EPC contractors. There's a lot of them have done well, and a lot of opportunities still exist going forward. The problem is understanding a few companies which you have enough confidence in. And I think this is again not the investing as a opportunity is so vast. You have to pick your spots. And again, I feel like building materials and metals. And again, in metals, I think there are quite a few companies that have done so well. Especially I think both small and large cap as well. But the question is, if you look at metals like steel and so on, it is a sort of a world market, and it becomes a little hard to understand what can drive those. And so you then have to go into areas where you feel you can understand that particular business well enough to be able to handicap what are the various factors that will drive the business. And I feel that you have to go into niches because if you go into industries which are very broad and the whole world influences them, then it will be a little harder for individual investors to benefit from. But if you can understand some niches and you can see that those niches will not be taken away, then you can find opportunities in those.
Thanks, really helpful. So next in line is data charts. You can unmute and ask your question to Rajiv.
Yeah, I was just gonna add to what he was saying because he was talking about valuations, and that's what your question was. So actually, real estate's pretty high, right? When it comes to its price to earnings on a forward multiple, right? It's around 62.8 on that forward multiple. So I would ask you a question: if you take a look at energy and financials, right? The banks have basically the major ones have had their earnings. Okay, financials has a 17.7 forward multiple, right? And energy's at 12.2. You take a look at financials, forecasted growth. So if you look at that, right, add in the PEG ratio, financials are interesting at this point. Would you say, with your comments also on building materials? So question one would be, would you want to look at other areas outside? Because real estate, the performance has been massive over the past 12 months. Okay. Would you want to look at other areas? And I'm not saying it's done, but I think your comments on building in the material side, I think that's very interesting. That's trading at a 30 multiple right now. Okay. So it's half the multiple of real estate. So what would you say to take a look at the picks and shovels, if you want to say, compared to the growing building boom that's going on, infrastructure as well, as you know, as a very strong area right now in India.
Right. So just to understand, data charts, you are saying that is building material an interesting space to look at? Is that your question?
Well, I was just adding to your comments on the multiples, right? And then you also had stated that you saw the building boom, right? That's been going on in India as well as infrastructure. Adding to what you stated, would you
Mhm.
say looking at those areas is it kind of cross labs, if you want to call it, or crossover? Okay, but financials and energy actually have the lowest multiples, right, compared to all the other sectors. Not industry group wise, right, but more sector wise. Because air
Mhm.
transport services actually are really attractive. There's only a few companies there with the growing aviation right sector that's going on in India. So just looking for, and nothing, I'm holding you steadfast. Also belong to the same organization that you do, the CFA and then the CMT. So just trying to ask, what would you say that that's also an area to look at, which is materials, but more building side and then infrastructure related? And then would you also want to look at possibly some of the financials?
Yeah. Okay, got it. Great. No, I think all those segments that you said, and you brought up airlines, and I thought that was again another very interesting one because for all intents and purposes, there are only a few airlines in India, and airlines are actually a boom sector right now. The way the airline passengers are growing, that clearly shows. And if you go to India, you just see how the air travel is growing. Clearly, infrastructure is being put in place. And it is a pretty consolidated market, not a free for all. So, clearly, I would say airlines could be interesting. I think the problem with any of these sectors, whatever company we take, the problem is not that a sector is good. I think many times when we're looking at investing, one of the mistakes many of us, not most, many of us make is we think a business is a good business and therefore it's a good investment. And that is where the biggest mistake happens because just because it's a good business does not make it a good investment. A good investment needs to have a good price because for the same investment, same good business, if the price is too high, it's a bad investment, right? And so going back to the example of airlines, if we take airlines, yes, it's a very consolidated market. But we know traditionally airlines have not done well, but that may be because it was a perfect competition in some markets, while in India, maybe it's not a perfect competition. There are only few players. I frankly have not done enough work, but it's an idea. And I think I should take a look at it because it is definitely a consolidated market with a significant tailwind. And there's possibly
Just to clarify, I was meaning air transport services. Yeah, if you take a look at Interglobe Aviation,
yeah,
i.e.,
yeah,
Indigo,
yeah,
right, or even
yeah, yeah.
SpiceJet, but air transport services, because you have a growing aviation industry, so that area is not as it hasn't really developed. Airlines, I agree 100%, right? And Interglobe Aviation is the prime example, right? Largest by passenger traffic, domestically in India. So.
Yeah. No, understood. Yeah. So that's one. I think on the building materials, you have to go case by case, is what I will say, because again, some of the building material companies, like the tile companies, have traded almost always at an expensive price. Cement companies, you are always looking at it in terms of the regional markets. Clearly, their reach, and you have some big players entering that market. Will there be unfair competition where some people will just dump the goods at low prices to take the market share away and drive some companies into difficult situations? We don't know. It's too hard to know. But building materials, my suggestion would be to go based on each of the materials that they have. Some people, for example, are actually doing some very cool stuff, innovative stuff, and as the purchasing power is increasing in India, there is desire to buy good products, branded products, and not just buy the cheapest products. And so, if they can have those brands be aspirational brands. I think some of them can do very, very well. So I definitely think building materials, given the growth opportunities in India, real estate and all of that, picks and shovels that you were talking about, I think that's definitely an area that one could look at. Finance, my view is finance. As I said, I like finance, especially the lending side. I think that will, my view is, um, and there is this study which says that if the GDP growth at X, financial companies grow at 1.5x, right? And if we think government has assumed 10.5%, I believe, for or 10% growth nominal for financial year 25. And if the nominal growth is 10% and finance companies then do at 1.5, then it's 15% growth. And that's a pretty decent growth at the industry level, right? So my view is that financial companies should do well. And again, within the financial companies, because there is a lot of competition, one has to look at which companies will do well. And I think that is what your analysis when you are doing the PEG price earnings to growth, what you were referring to. So I think financial companies, my view, will do well. The aviation sector, there are some also airports that are listed. Possibly one could look at indirectly, directly, and that could also be interesting.
Great, thanks.
Can I ask a quick question on that, because this is a quite a relevant, very important point you said. I wanted to, on the earlier point about, what the companies that you like and the areas you like versus the real smart investment. So of course, everybody has their own particular area to look into, right? And I've been looking at the green growth segment. In fact, I have a big event coming up on May 21st at the Indian Consulate. If you're available, Rajiv G, please join. So where do you think that, we've seen in the last few years, right? We've seen this energy crisis, but also this opportunity of renewable energies, right? We've seen the G20 announce the international, biofuel alliance. We have the international solar alliance that India has been pushing, and recently Prime Minister Modi talked about, the rooftop solar as a big opportunity for India. And we see completely in Texas and some parts here in Northeast, we see this, whole focus on solar coming back. Green hydrogen is another big thing with the IMEC announcement of G20. MBS saying that future will be where Saudi Arabia will be importing the green hydrogen coming from Adani. So, what do you think from a long-term perspective? I know that we don't see the clear, bright skies right now, but completely from a long-term perspective, where do you see this? Is it really wise to get into, or wait and watch? What is your personal take, without of course recommending any companies? Just wanted to hear your wisdom on this.
Actually, renewable energy. By the way, I would love to hear more about the consulate event. I would definitely, if possible, attend that. So let's connect offline and see if I can participate in that. On the green energy, actually, I'm very bullish. And what the reason I'm bullish is because the cost of green energy actually has come down quite dramatically, and of course, it cannot be a base load, so there has to be some way of storing it, and that's where green hydrogen comes in. And I think the whole ecosystem is starting to come together very, very nicely. Now, both on the wind energy and the solar energy, I feel, given the new machines that are coming up. So let me talk about both wind and solar, and then hydrogen from an India perspective, and then maybe a little bit from a US perspective. But from an India perspective, I think the whole desire that the government has laid out by 2030 to have 500 gigawatts of renewable energy, I think that's very commendable. But not only is it commendable, I think it's very achievable as well. And I have been tracking, especially the wind energy side. And we do, in full disclosure, possibly we also own some wind energy stocks as well, right? But in wind energy, I think the sector was in huge doldrums between, let's call it 2016 to 2023, because effectively the government moved from what is called as the fixed tariff to auction based, and market participants being what they are, they actually suddenly got very excited and started bidding projects that made no sense. And so for the last 6-7 years, the sector was in huge doldrums, and then only from this year or late last year, things have started turning around quite significantly. And it is because now again, the auction regime has changed. There is much more sanity in that market, and also the government has a pretty pretty compelling long-term program where they're talking about 500 gigawatts total renewable energy. There's a certain amount for wind, certain amount for solar, and both of them, from an India perspective, given we have huge shorelines, a lot of solar that comes into India just because of the geography of India, there is a huge opportunity for India to take advantage of. And I think as hydrogen becomes more of a mechanism to store some of this energy which cannot be used when it is generated, I think it becomes a pretty compelling ecosystem without necessarily needing as much battery, because as you know, round the clock energy can be quite expensive with renewable energy. So once the round the clock energy starts coming in, and that cost is lower than your base load, then it just will of course take off. But in the interim, the government has announced programs where they're talking about renewable purchase obligations, both wind energy, solar energy. A lot of the corporates are, irrespective, putting in their own renewable energy because plants, because that is what their customers want them to do. And so there is an incentive from being able to take advantage of what the world is moving towards. So I think my view is this whole sector will develop very nicely. Like anything, there's always a possibility that things go to excess, and especially we have seen that the module prices in the solar ecosystem have fallen dramatically in China, for example. And so it remains to be seen as the PV cells are set up, what that will do to the pricing that people are setting up the solar power plants or the solar panels or the solar batteries, or not batteries, but solar panels, right, in India, and how viable that is. But clearly, I think Indian government is on the right track. Now, coming to the US, I think US, as many of the folks would know, I am a regular at Berkshire. If you go to Iowa, you cannot but help notice those big wind energy mills everywhere, right? And it's amazing to see. And Warren has always talked about how Iowa is the Saudi Arabia of wind. So I think in US, I think clearly there are certain geographies where there is a lot of wind energy that is available. I think what is not less clear to me is whether the offshore wind that we started doing in the Northeast, how viable that is, how costly that is. It's not obvious to me because some of the plants have been cancelled recently for lack of viability funding. Um, India is doing offshore wind. I'm not as convinced whether that is going to be as successful just from a economics perspective. So I think the offshore wind is an open question, but I think onshore, especially if you have the right geography, the right windy conditions, can be very interesting. And then solar, depending on what geography you are, can be very interesting. I think once the round the clock cost comes down, I think it is bound to take off. And I think we are getting closer and closer to that.
Sorry, but I just have to say that I had no idea that you were so bullish about the renewable energy sector. I've sent you a DM, but just for people, just on the information that if you're in the US area in the Northeast, we are doing an event. Vineet, Prince, are the founding member with me of the Green Growth, India 2047. So you see that there is a handle here called India at 2047. So the basic idea really came through this event that was hosted last year at White House. We were there for the CEO's event, and we were looking at the green growth segment where India and US are really coming together in the area of renewable energy. They're coming together very strongly on sustainable infrastructure, transportation. And the third area is also agri-tech and food tech. These are very pet areas for me, and we will be doing on an AI question that came earlier. We will be doing a deep dive on AI with the Honorable Union Minister of India, Rajeev ji, in the next 2 weeks. So if you really want to know what's happening in India, what is the opportunity, what are the startups, who are the movers and shakers, we will be bringing a key group of people because it's definitely a big opportunity for us. And Rajiv ji, I've sent you my WhatsApp number and the invitation, and we should definitely meet in the coming days.
Absolutely.
Okay, everybody. Lovely, everybody. Let's go on, Prince, with the next speaker. This is fantastic.
Thanks, Ravi. And I once again request our audience to connect to Rajiv sir's handle. You will find plenty of good tweets wherein you can add to your investing knowledge. So, Rajiv sir, if coming to the energy storage space, what would be your view around those and what are the developments happening at this point in time, if you can apprise us?
Yeah, Prince, I actually would not have too much to add on the energy storage space. I think, frankly, many people here might have better understanding, but I do think that energy storage, traditionally through the whole lithium ion battery and stuff like that, is fine. I think it's just too expensive. And so, to me, what is interesting is India is now starting to talk about the hydro power storage, which I think is interesting. I just don't know how efficient it is. And then, of course, over time, green hydrogen could be an interesting space. So, a pretty superficial level knowledge is what I would say, Prince, I have. And I don't think I necessarily will bring too much to the table on the energy storage.
Thanks, sir. So, Vineet, you can ask your set of questions.
Thanks, Prince. So Rajivji, on two sectors that you spoke about, which you're following and which I am following closely and I like as well, financials and real estate. I had one question on each. In fact, I had a theory on each of the sectors, and I want to know what your thoughts are on both of them. So first on real estate, I think the building material space that you spoke about, the one space among building materials which I think is a slightly late cycle play in real estate is the tiles and the ceramics, the sanitary ware section, because most of these materials are purchased towards the end of the life cycle of the projects, and because real estate started going into a massive upswing about a couple of years back, so the first set of projects which were launched in 2021, 22 early as well, are getting to completion stage now. And my sense is that many of those projects will drive a significant spike in demand for sanitary ware and tiles and ceramics players. And in fact, if you look at the numbers of these players, the reported numbers, there has not been too much of growth actually. Whereas growth in absolute pre-sales of real estate developers, as well as the other building material spaces like cement, uh, and also wires, electrical systems, etc. All of those have been showing good numbers because those are all early and mid-cycle plays. So I wanted to get a sense from you if this line of thinking makes sense, and if that's the case, we might see a big spike in earnings in some of these ceramics and sanitary ware players, maybe over the next 12 to 18 months, and then obviously it keeps on increasing with the rest of the cycle. So that's the first theory which I want you to confirm or deny on real estate. The second is on financials. Uh, and I was just reading this report recently where, and it had a very interesting point where they spoke about how in the US the top four banks account for about 40% of all assets, and how now in India, even in India, the top four banks are about 30 to 40% of the assets. So now that the top four banks are this large in India, will we still expect 1.5 times GDP level growth for these big banks, or is it more likely to be in line with GDP because they're already a significant share of the overall economy, and we have a reference point in the US where this share in total assets tends to cap out at about 40 to 45%, and so maybe the market share expansion that has happened already for the large banks so far, the large private banks at least, may start slowing down over a period of time. And if that's the case, then what other segments within the financial ecosystem do you like, and what your thoughts are on some of the niche lenders, for example, so lenders in spaces like green energy or MSMEs, which are spaces where a lot of traditional banks are not lending, and so maybe the competition that those lenders will face will be a lot lower, and it might give them the opportunity to price up slightly and protect their NIMs in a high interest rate deposit clash environment. So just wanted to get your thoughts on both of those questions. I'm sorry this was slightly long, and I can repeat them if you like.
No, I think Vineet, I got the gist of it. But if I don't address your question, feel free to sort of ask again, because in between my connection dropped off and then I came back in. But I think I got the gist of your both the points that you made. So on the tile ceramics, I think I fully agree with you that if you listen to them, that is what they are saying. At least, right? The companies are saying that, oh, you know what, the real estate cycle has just started and it will start showing up in our numbers in a few quarters, right? I think what will be interesting to see is, and this is where we have to just to compare each of the business models to say how much of these tile ceramics are they exporting versus domestic, and if they are into domestic, what proportion of the domestic goes to the players or to the areas which are really experiencing growth. But I think the thesis or the gist of what you are saying makes perfect sense to me, that the tile, ceramics, sanitary ware are all late cycle sort of businesses in the real estate, and they should benefit because once the building is complete is when these things will be bought and used. And so as things are getting built, this should happen. And I would agree with that. I just want to, you know, trust but to verify is what I would say. And so I think to that extent, it is something that we should be looking for. And I would agree
Right.
with you that it makes a lot of sense. Yeah.
Perfect. No, that's a great answer. I think trust but verify is absolutely crucial. Uh, yeah, the
Yeah.
theory works till the numbers don't come in, of course.
Yeah.
And
Yeah.
on the lending piece.
Yeah. So on the lending side, I agree with that you don't want to be in areas where there's too much competition, and that is true for almost any area, be it lending or anything else. And so I think being in niche segment is important, where there is a decent runway, right? And so I think the MSME segment again is something which has been starved for credit, as we all know, right? These small shopkeepers, small businessmen, small factories, they have been really not having a way to get the credit to grow their business. And frankly, these are some of the hardest working people. You give them a little bit of credit, and their lifestyle changes, not lifestyle changes, but their business changes dramatically, and that allows them to start making a lot more money. So I think MSME, again, you look at some of the reports out there of how big is that credit opportunity, huge. What is interesting to see is more and more lenders are able to address that market. And it is also interesting to see that more and more data points are now available for these businesses, right? So, for example, GST. Now, almost everybody has those GST information, and a lot of these lenders are actually able to use that information to be able to, or payments information, for example, to be able to make credit decisions. So I think the information is becoming available and the opportunity size is huge. And therefore, I think it's again a very interesting area for one to look at and see. But I would also think that because this is happening, it is not over a few years. I think it will become more mainstream and not may not remain as niche, right? Because something will remain niche if information is not easily available. In this case, I feel that information will start disseminating and becoming more easily available over time, and therefore it won't remain niche for a very long period. But we don't need a long period. We just need to make do well in certain segments and then figure out the next one.
No, completely agree, Rajivji. And I think you're absolutely right that competition will come in and will start competing away margins. But at least in the short term, I think there's uh, you know uh, there's a slight demand supply mismatch. In fact, one of the companies that I track, I was listening to the management recently, and they made a very interesting point. Actually, they said that because GST has brought in formalization, and a lot of the smaller companies which were not a part of the formal economy and which were dealing largely informally and in black money, are seeing that if you become formal, you actually get access to credit now, which you did not get previously. So it's almost
Yeah.
become an incentive for a lot of informal black money based businesses to come into the formal economy. So that I think is an excellent tailwind. It's almost like a flywheel effect, because when one business sees it and then that person's friend finds out that this guy is getting credit now, he's more likely to get into the formal space as well, and it just compounds over a period of time. So I think it's a very interesting space.
Yeah, absolutely.
So Rajiv, like coming to the PSCs or PSU space, do you think like after the election we may see a divestment or OFSs coming in the companies, and there could be some drawdown in line of that?
I mean, there could be divestment. I mean, it is interesting that the government obviously had a certain expectation of divestment for financial year 24, which they will miss, especially given the markets are strong. And I think what it is telling me is that the government feels there's is still more runway ahead for these businesses. I would not be surprised if the government divest, but if the businesses perform well, it may not be a negative for these businesses, is how I feel. Because to our point earlier, Prince, if there is enough money coming in every month because of SIPs and other mechanisms from a domestic money that is flowing in, that money has to find good businesses. And if some of these PSU businesses are run in a manner that gives us the comfort that these businesses are good businesses, I think there is no harm in government if the government reduces their stake and then new money comes in from retail or other people who is able to take that place in the capital stack, right? So I am not necessarily as much worried about divestment as long as the business is run in the right manner, because I think what is different this time around is there's enough flow of capital that is happening into the equity market.
Right, sir. And Rajiv sir, there are many people from US, and of course, most of us are from India only. But would love to hear you out on the Doordarshi India Fund, so that if, I mean, people will know what your thought process goes in that fund and how they can connect with you, just in case anybody wishes to.
Sure. So Doordarshi India Fund, it's a US based hedge fund. We are registered in Delaware, and then we are a FPI, foreign portfolio investor into India. And our focus is investing in listed Indian equities. That is what our focus is. The fund has been in existence for almost 3 years. Our focus is basically what you would have heard on the call today as well, that our focus is to find good companies and good valuation with good management. And I think this third aspect, the good management, we haven't talked too much about in today's conversation. But I think that is fundamental and paramount for one to do well in the Indian equities. Because unless you are partnering with good management, it is very hard to make money, except for periods like 2023 when things have all gone up. But one has to be careful that you are partnering with good management. And I think I always feel that to know if a management is a good management or not, and this is a typical question that comes up when I say good management, how do you know? Well, the way to know is to look at their track record, right? What have they done? Because I always tell people talk is cheap. It doesn't matter what somebody is saying. Or what I was saying earlier, trust but verify, right? So I think management, if they're good, they will leave their marks, and you can from that judge. And one of the simple barometer that we use is what do they say versus what do they do. And we want people who say and do things which are consistent, and we don't really want to work with management. Even if there's a lot of money on the table, we are happy to leave that if we don't feel that this is a management that we can trust. So that is our approach. We are a concentrated investor, like to invest in around 20 odd stocks, though we give ourselves a lot of latitude. And we want to invest only in companies that we can understand. I think there are stock market, Indian stock market, any stock market has a lot of opportunities. We need to identify areas that we understand and take advantage of. At the same time, we continue to look for new opportunities, and we are very happy with the opportunity set in India, even though the private markets have gone up, because we feel there's still a lot of good opportunities. And I think our view is that Indian stock market will give outsized returns over the next 10, 20 years, as it has done in the last 30 years. So many people don't realize this, but Indian stock markets, if you look at in the last 30 years, have done almost a 7.5% dollar returns. And that is second just to the US stock markets. And again, people think, oh, Indian stock markets are emerging stock markets, very volatile. But they don't realize that Indian stock markets have performed fantastically well. And it has been the highest performing Asian stock market in those 30 years. So the past is good. The future looks even more promising. And so that is one of the reasons why we are focused on that. And we feel a lot of innovation, a lot of excitement, a lot of energy actually in the whole Indian ecosystem. And that is a good cocktail that we want to take advantage of. So, and we have been investing since April 2021 when we started the fund. We are far ahead of the benchmarks, be it US or Indian benchmarks, and so we are very excited about that, and we feel there's a good long runway for us in the future.
Great, thanks, and wish you tons of success. And I sincerely believe the kind of framework and clarity of thoughts you have. So definitely from here also, you and your team will be going to do tremendously well. And thank you so much for taking out time today. It's always a pleasure listening to your thoughts, and surely look forward to many more conversation going forward. Ravi, you have anything to say on your part?
Yeah, absolutely. Yeah, I just want to thank Rajivji for extremely insightful detail and having so much of time and patience to be with us. And I'm definitely going to, I've already DM you, we should definitely connect. But I also want to thank Prince because he really brings most amazing speakers from all over the world to learn about the market, just not in India, and also we're looking at this convergence of India and US coming together more and more closely. I think that's so unique to see happen, right? I think there's a huge advantage of the diaspora community working with leaders such as Prince and others to really bring these two markets together. And that has been a very big wish list for some of us in India and in US to make sure that the Wall Street and the Indian market are going to really work in synergy as we're looking into the next 20, 25 years. So with that note, thank you so much. I really encourage everybody to follow Prince, the host, so that you can don't miss any of the amazing speakers that he brings. Please follow our lead speaker, the Rajiv ji. Go to his timeline, retweet some of those important tweets that he's been giving. They're very insightful. There, we are just lucky to have somebody like him who's doing the research for us, and it just comes in a platter to us. Again, great person here is Wall Street to look at bitcoins. So everybody, thank you so much, and back to you, Prince.
Thanks. And guys, those who joined late can listen to the conversation. We record this session and upload it over my YouTube channel that goes by the name of Accidental Investor Prince. So thank you so much, Rajiv sir.
Thank you, Prince. I think I will just echo what Ravi said earlier, and that is that I think Indian and US ecosystem are coming closer together, and that's one of the best things that we are starting to see. And the more that happens, I think it creates opportunities for almost everyone, because it is not something that we have seen this type of closeness, this type of opportunities of leveraging each other. Ravi talked about the fact that there is this whole green energy thing. I feel that's wonderful. Similarly, Prince, I think what you have done for the whole ecosystem, making, getting good people, but helping have any listener come in and ask questions, I think it's amazing, right? I wish I had this platform 10 years back or 20 years back. That would have accelerated my learning dramatically. And I think what you continue to do is amazing. And we can all learn from each other. Like, here I am a speaker, but I'm sure from this session, I will get a lot of new insights into various different segments. And I think that will be amazing for me. So thank you for the learning and for also allowing to give my thoughts to the audience today. Thank you very much.
Thank you,
Can I
sir.
can I
And
just say
I
for folks who want to look at the India US market coming together, Do follow India 2047, which is contributing to Honorable Prime Minister's vision of making sure India reaches 30 trillion plus economy. And we're seeing some very important signs of that. And, we welcome everybody to be part of that journey. And we organize, one Twitter space just on India 2047 every month. Last month, we had the BJP spokesperson for economic affairs that, Prince and I co hosted. And this month, we will announce the date. We'll have the Union Minister, Rajeev Shekharan, talking about AI and DPI opportunity and what is that is there for the investment opportunity there. Thank you so much, everybody. And we'll be back soon. Prince.
Thanks. And Rajiv sir, as you were discussing, it's a virtuous circle wherein the speaker, the host, and the great audience who are sparing time over weekend to listen to our long conversation. So it's a win-win situation for everyone as other. And the only idea is to educate. We always avoid talking about stocks because we recently saw an event on G News, right? So some influencers were doing something what we call front running. So for that reason, we always prefer not to talk about stocks with our guests, and our guests are also of the same opinion that the framework or the process is more important, because you should be keeping in the market for long only if you have your process right. And as Rajiv sir rightly said, do not look for tips. Naming a company is the easiest thing, but how to behave after you invest is indeed a very topic which everybody should be taking cognizance of. So with that note, I thank everyone for participating today, and special thanks to Rajiv sir for sharing his decadal experience with us. Thank you so much. Good night. Take care.